In the world of finance, some moments stand out, defining an entire era for an asset class. For silver, October 2025 was one such moment. The month witnessed a price explosion that sent shockwaves through global markets. It shattered records that had stood for decades. On the 13th of October, the spot price of silver surged with breathtaking speed. On the 14th of October, it pushed even higher, climbing above $53 per ounce. This was not just another rally, it was a historic milestone. The price eclipsed the infamous peak set during the Hunt Brothers market corner in 1980. It also surpassed the high reached during the post-financial crisis boom of 2011. It was a new all-time high. By the middle of October, silver's price had skyrocketed by more than 70% since the beginning of the year. That staggering year-to-date gain meant silver was vastly outperforming most assets. It outpaced many high-flying stocks. It even outperformed gold. Investors who had held positions were rewarded handsomely. Those on the sidelines watched in awe, wondering if they'd missed a once-in-a-generation opportunity. This wasn't a slow, steady climb. It was a rapid, almost violent repricing. It forced everyone, from retail traders to major financial institutions, to pay attention. The surge wasn't random or a fleeting speculative bubble. It was the culmination of a perfect storm of converging factors. Drivers spanned from the broad macroeconomic environment to the granular details of physical supply and demand. Geopolitical tensions provided the spark. Deep-seated structural issues in the silver market provided the fuel. Understanding this run requires us to dissect these interconnected forces. That means looking at global inflation trends and examining central bank policies, also the specific needs of high-tech industries, and the behavior of investors caught between enthusiasm and fear. In this deep dive, we'll unpack the complex story behind silver's historic rally. We'll explore four primary pillars that supported the unprecedented price movement. First, macroeconomic tailwinds, persistent inflation, shifting interest rate policies. Second, critical supply and demand dynamics, a structural squeeze in the physical market. Third, geopolitical shocks, policy decisions that acted as catalysts. Finally, investor behavior, and a comparison of the 2025 rally to past silver booms. The first major force propelling silver to its record heights was the macroeconomic landscape. Throughout 2025, a potent mix of economic conditions created an exceptionally favorable environment for precious metals. Persistent inflation, which had remained stubbornly high despite central bank efforts, continued to erode the purchasing power of fiat currencies like the US dollar. As the value of paper money dwindled, investors naturally sought refuge in assets that have historically served as a store of value. Silver, often called poor man's gold, became a go-to hedge against this inflationary pressure. Adding to this was the anticipated shift in monetary policy. After a period of aggressive rate hikes, the Federal Reserve signaled a pivot towards rate cuts, which further burnished silver's appeal by reducing the opportunity cost of holding a non-yielding asset. Beyond the broad economic trends, the rally was fundamentally driven by a severe and worsening imbalance between supply and demand. This was not just a temporary mismatch. It was a structural squeeze on the physical silver market. For 5 consecutive years leading into 2025, the world had been consuming more silver than it produced, leading to a significant and cumulative deficit. This shortfall was draining global inventories at an alarming rate. Layered on top of these fundamental drivers were a series of geopolitical shocks that acted as powerful catalysts. The year 2025 was marked by significant global turmoil, including ongoing military conflicts, and the eruption of new tensions in the Middle East. These events heightened risk aversion and spurred a flight to safety, with investors piling into traditional haven assets like gold and silver. Furthermore, renewed trade war rhetoric between the United States and China, complete with threats of massive tariffs, rattled markets, and raised fears of global supply chain disruptions. This climate of uncertainty was amplified by domestic political dysfunction, including a prolonged U.S. government shutdown, which shook confidence in economic stability and the reliability of government institutions, making tangible assets even more attractive. Finally, the behavior of investors themselves played a crucial role in amplifying the price move. Investment demand from both retail and institutional players surged to record levels. Retail investors, driven by a fear of missing out, rushed into the market, buying up physical coins, bars, and silver-backed exchange-traded funds. This retail frenzy was so intense in some regions, like India, that it created localized shortages and dramatic price premiums. Meanwhile, institutional investors, who had often viewed silver as secondary to gold, began to take the metal's structural story more seriously. This combination of widespread retail enthusiasm and growing institutional acceptance created a powerful feedback loop, where rising prices attracted more buyers, which in turn pushed prices even higher, culminating in the historic peak of October 2025. The historic surge in 2025 naturally invites comparisons to silver's previous dramatic price spikes, especially 1980 and 2011. 1980 labeled Hunt Brothers Corner. The Hunt brothers tried to corner the market. They bought massive quantities as an inflation hedge. That buying created a short-lived bubble. Exchanges intervened, and the price collapsed spectacularly. The 1980 spike is a cautionary tale of market manipulation. 2011, labeled post-crisis rally. 2011 was driven by powerful investor demand after the 2008 crisis. The Fed's quantitative easing stoked fears of dollar debasement. Gold was soaring, and silver rode its coattails. But 2011 was still largely investment-led and speculative. Industrial demand wasn't a major factor then. When the speculative fever cooled, the price corrected sharply. 2025, labeled the structural squeeze. 2025 marks a new paradigm, different from past rallies in two fundamental ways. First, dominance of structural industrial demand. Solar panels, electric vehicles. This demand is robust, long-term, and largely price inelastic. It's baked in by multi-decade policies and technological necessity. As Bank of America noted, structural forces were the primary drivers. Second, deeply depleted global inventories. Years of chronic supply deficits drained the world's stockpiles. The market experienced a genuine physical squeeze. In 1980, the shortage was hoarding. In 2011, there was no real shortage. In 2025, the cupboard was truly bare relative to demand. That mix, inelastic industrial demand plus tight supply, creates a resilient foundation for higher prices. While past rallies were mostly paper-driven investment events, 2025 was a real-world physical imbalance. That makes the 2025 surge fundamentally different and potentially more sustainable. In conclusion, the historic silver rally of October 2025 was not the result of a single cause, but the powerful culmination of a perfect storm. The stage was first set by a highly supportive macroeconomic environment. Persistent, sticky inflation drove investors to seek shelter in hard assets, while the Federal Reserve's anticipated pivot toward interest rate cuts made non-yielding silver a far more attractive proposition. These factors, combined with a weakening US dollar and growing fears of currency debasement, created a powerful incentive for investors to move capital into the perceived safety of precious metals. This macro backdrop provided the initial, powerful tailwind that lifted silver and prepared it for its dramatic ascent into record territory. Layered on top of this was a deep, structural imbalance within the silver market itself, a genuine physical squeeze that had been years in the making. Chronic supply deficits had systematically drained global inventories, leaving the market vulnerable. On one side, stagnant mine output, hampered by its reliance on the economics of base metals. On the other, demand was exploding. The green energy revolution created an insatiable and price-inelastic appetite for silver, in solar panels, in electric vehicles. Meanwhile, a tsunami of investment demand, channeled through ETFs and physical purchases, took millions more ounces off the market. This fundamental mismatch between soaring demand and constrained supply was the core engine of the rally. The market's internal stress soon became impossible to ignore, flashing clear warning signals of an acute physical shortage. Soaring lease rates in London, which spiked to unprecedented levels, screamed of a desperate scramble for physical metal. The futures market flipped into backwardation, a rare condition indicating immediate possession of silver was more valuable than a future claim. Meanwhile, the global market fragmented, with prices in London decoupling from those in New York due to logistical bottlenecks and policy-induced bottlenecks. These were not theoretical indicators. They were real-time evidence that the physical supply chain was breaking under the strain, justifying the sharp upward repricing of the metal. Finally, a volatile geopolitical landscape provided the spark. Ongoing global conflicts, renewed trade war tensions between the US and China, and widespread political instability spurred a classic flight to safety, driving even more capital into bullion. It was this unique combination of macro trends, fundamental tightness, market signals, and geopolitical catalysts that created the perfect storm, pushing silver past its long-standing records. Looking ahead to 2026 and beyond, the outlook for silver remains complex. The key question for 2026: will the physical squeeze continue to dominate the narrative? What do you think lies ahead for silver? Will fundamental deficits push prices to new heights, or will the rally fizzle out? Tell us in the comments. If this analysis was helpful, please give a thumbs up and subscribe to express EconGeoFinance Insights. Thank you for watching.